Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He has had a very long career as a resource investor, a lot of successes. He's also a resource company creditor, investing and loaning to commodities companies through bull and bear market cycles over the decades in a lot of different types of commodities. He's a former vice president at Sprott. He also started his own firm, and now he's semi-retired, as he just said, right before we started recording, and he's running Roll Investment Media. Rick Roll, thank you for joining me again.
Jason, always a pleasure. It's been a long time.
Yes, and I think we're coming on at a good time because there's a lot more opportunities here now, and we'll talk about this in the next 45, 50 minutes about commodities. Now that the air is out of the balloon, I think there's a lot of good buying opportunities.
It certainly is more attractive. The longer-term outlook had been attractive for a while, but as you suggest, particularly among the juniors, the equity pricing just got too high. The opportunity was present, but the opportunity cost was unpleasant. And that's changed very, very rapidly.
So my first question for you is, what do you think are the biggest risks right now to the commodities complex?
That one's easy. Recession. It is inevitable in my books that we're going to have supply shortages across the commodity supply chain. But supply shortages don't necessarily result in higher prices if demand falters. So a global synchronized recession or depression would throw a loop in the commodity prices. In the very near term, too, higher interest rates depress prices for all equities, both because higher interest rates raise the cost of capital to companies, but they also lower the capitalized value of the dividend distribution, sort of thing. So on the one hand, your margins get squeezed, and on the other hand, your multiple gets squeezed too. The third thing, of course, is that higher U.S. nominal interest rates make the dollar stronger. Commodities being priced in dollars, you can have a strong commodities market offshore and a weak commodities market onshore simply because the denominator, which is to say the U.S. dollar, is strong. So I would say those are the three principal risks.
You don't think that capital available to mining companies, oil and natural gas companies, is a major risk?
No. The oil and gas business right now is frankly overcapitalized. They are, despite the fact that the industry as a whole is deferring about $1 billion a day in new project and sustaining capital investments, they are increasing dividends and share buybacks. And so relative to the capital expenditures, relative to the ratio of capital expenditures to free cash flow that we've seen over the last 20 years, the oil industry, as an example, is overcapitalized. The junior mining business, or rather the junior exploration business, might be undercapitalized from the point of view of the issuers, which is to say that many companies are experiencing difficulty raising money. I would suggest that is as much as not to blame on the poor track record overall of the junior mining business in exploration and return on capital employed. I do not agree that the mining industry or the oil and gas industry is undercapitalized. There is a lot of capital available for good people and good projects. It's just the layman, the halt, and the blind are having the problem that they deserve with regards to raising capital.
So the low-cost gold mines, the low-cost silver mines, the ones that actually have good project economics on like their feasibility studies, those are the ones that are still under construction that are getting their funding. It's the higher cost projects that maybe need gold prices above $1,800 an ounce, or they need $100 a barrel oil, maybe they're deep water offshore projects. Those are the things that are not going to, or $4 a pound or higher copper. Those are the things that are their funding is going to collapse or not available right now.
I think a lot of the marginal projects are having trouble getting funded. And of course, if you are in a circumstance like we are right now with equities prices falling, which is to say a risk-off market, third world, emerging market, and frontier markets are challenging to fund right now. We are obviously in a risk-off environment, and the institutional investors in particular prefer traditional countries where they understand the risks. I'm talking about Australia, the United States, Canada, to the extent that any projects might be available, Western Europe. finding money for average projects, not fantastic projects, but rather average projects in frontier and emerging markets is a challenge.
Hasn't there been enormous bidding wars for a lot of Canadian gold and copper mines in the last 3, 4, 5 years? It seems that anytime a halfway decent project with halfway decent project economics, slightly above marginal, not even necessarily a low cost project, that a lot of these larger senior miners and mid-tier miners are making big premium bids on these projects.
The prices that are being paid for mid-size Canadian projects astonishes me. We've seen projects that have gone out at what we consider to be 1.6 or 1.7 times NAV based on current commodity prices. It might be that the bidders are smart enough to find a whole bunch more mineral than has been reported there. But the point you make is, from my point of view, extremely prescient. The market has been very, very generous for bankable feasibility study stage properties, or for that matter, some of the bigger producing properties have been bought. There have been extremely generous valuations from my point of view.
Do you think the producing miners want the safety, the relative safety of investing in Canada, so they're paying a higher premium for that? Or are there other reasons for this?
I think that's one of the reasons. I think that what you've seen is that larger companies that have greater market capitalizations end up with greater trading volumes, and as a consequence have a lower cost of capital. I think the other thing that you see is that sometimes the acquirers have felt themselves to be fairly fully priced. And if it was a share transaction, in the odd calculus of mining finance, if your stock is selling for 2.5 times what it's worth, you can pay 1 3/4 times what something else is worth, and it's accretive if you get my drift. I suspect that you will see fewer extraordinary premiums simply because both the GDX and the GDXJ are down so dramatically. It may be that as the acquired companies fall in price dramatically, that the share prices that are falling around the acquiring companies will still make sense. But I don't think you'll see the eye-popping acquisitions in the market that you saw a year or 2 years ago.
I don't think there's as many Canadian projects to buy. I mean, Yamana Gold has done very, very well with Canadian Malarctic. That's turned out very well for them. But we just saw in the last, 7 months, we saw Kinross Gold pay an astronomical price for Great Bear. And Great Bear is pre-resource. They don't even have a pre-feasibility study out yet.
I was amazed at the price that was paid for Great Bear. Now, there is an awful lot of geological upside at Great Bear. And I'm prepared to believe that if Kinross throws a bunch more money on exploration at it, that they may make the thing worth it. I couldn't have paid for that because I didn't have enough confidence in the resource base to do it. I hope they're right.
Yeah, normally for listeners out there, normally the larger miners, say a Newmont Mining or a Barrick Gold, they will not go and bid on a junior unless there's a pre-feasibility study in NI 43-101, or the project is even further along than that. So for Kinross Gold to go and pay that type of price, that type of valuation for something that's pre-resource before the pre-feasibility study is out is pretty incredible.
It showed real confidence, and I guess it showed perhaps that Kinross wanted to be back with a more North American focus. Obviously, they've been a global company for a very long time, deriving revenue from Chile, deriving revenue from Russia, deriving revenue from Mauritania. For all I know, this is a return home, but I don't know why they did what they did.
So even though commodities prices had a bull market for the last 18 to 24 months, except for the last 3 months, because commodity future prices have crashed pretty much across the board, do you think that any major supply side problems will actually be solved for the long term with new supply that's come online from the commodities bull market that occurred in the last 2 or so years?
No, no. I mean, we began the process of restarting exploration, but the truth is that we have underinvested and malinvested in the commodity space, in the extractive space for 3 decades. And you don't cure 3 decades worth of underinvestment and malinvestment in 2 or 3 years. If you look, as an example, at the copper business, yes, in fact, Oyu Tolgoi will eventually come online. Yes, Kamoa-Kakula in Congo has made a big difference. But most of the large copper deposits in the world, Jason, are older than me, and that's saying something. Bingham Canyon's 160 years old. Chuquicamata's 110, 120 years old. Even the newcomers like Ertsberg are 40 years old. We need to be developing a very large copper mine every year, and we're developing a very large copper mine every 5 years. And while $3.50 or $3.60 US cents is plenty of money for the great big existing copper mines, where $4 or $5 or $6 billion in capital cost has already been spent. But the incentive price to bring on some of these big new porphyries around the world is more like $4.50. We aren't there yet. Exacerbating that problem is that governments around the world get greedier and greedier and greedier. And so after the major mining companies spend $5 or $6 billion building out a big mine, they're faced with a host government that, having trapped the $5 or $6 billion, wants to renegotiate the fiscal terms. The overriding problem, I suspect, is well documented in copper, because the average mined grade in copper over the last 30 years has declined from 1.5% to 0.5%, which means that the rock that we're mining today contains a third of the copper on a unit volume as the copper that we mined 30 years ago. These aren't, in the near term, surmountable problems. And the problems, by the way, aren't limited to copper. I use it for illustrative purposes. If you look, as an example, in the oil and gas business, we had a wonderful convergence in technologies, which is to say three-dimensional seismic, measurement by drilling, horizontal drilling, multi-stage, polymer fracturing, that brought on an awful lot of incremental oil and gas supply, particularly in the United States and Canada. But in terms of the globally significant conventional producing fields, they too are very long of tooth. Goar came on production. It's the biggest field in the world, 1953, if my memory serves me correctly. So it's 69 years old. Cantarell, the big Mexican field, by now is in terminal decline. We have the same circumstance across the commodity sector, which is to say, with certain exceptions, I would suggest that thermal coal, metallurgical coal, and iron ore, we have adequate developed reserves for a very long time. But looking through the rest of the commodity stack, we are going to experience supply shortages almost inevitably if we don't have an ugly recession, which lowers demand as well.
To add to your points there on copper, the Oyu Tolgoi project in Mongolia, which is going to be one of the 5 largest copper mines, I mean, that mine has had enormous construction cost overruns and problems with taxes and royalties with the government. It's been, the underground portion of the mine has been delayed, I think, 8 years now. It's been delayed a very long time. There's been billions of dollars in construction capital cost overruns. So these type of giant, massive mines, they take a long time. And then if the copper price, say like 12 months ago, I think the copper price got to around, $4.50. I think for a brief period of time, it was $5 a pound. You immediately had governments in Chile, Panama, talking about putting on very punitive copper royalty taxes, like a new copper royalty tax is a sliding scale one. So the higher the copper price was, the higher the copper royalty tax was. And this is going to disincentivize these mining companies from making these giant investments in new copper production.
Very true. Very true.
Well, you'd think that you think then that with the copper price, if it's correcting, then that the governments will, I guess, if they have the sliding scale copper royalty, then the tax will go down. Or do you think the governments are going to eliminate it and then they're going to go back to playing the games when the copper price does rally eventually?
I think it depends country to country to country. I think you've seen, particularly in Chile, a fundamental political shift from intelligent to stupid.
And you mean to socialism?
Yeah, I think that that government, that government will be punitive towards the copper business simply to score political points with some people in society who believe that the copper miners have gotten rich and they haven't, and that's a bad thing. In other words, I think that they will be never mind stupid fiscally. I think they'll be stupid politically. Places like Mongolia are a bit easier to understand in the sense that the biggest industry in Mongolia until Oyu Tolgoi was literally livestock. And neither the society nor the government had any particular experience or expertise with regards to mining. And the relationship between Freeport and the Mongolian government was one where, at least in the beginning of the exercise, all the capability was on the mining company side. The government had no capabilities, and the citizenry had no sophistication. So the political process in Mongolia, I think, was much less cynical than the political process has been in Chile. By the way, lest your listeners think that all of the political risk is in countries that they have a hard time pronouncing, spelling, or finding on a map. One of the best undeveloped copper deposits in the world is called Resolution. It's pretty close by Republic, Arizona, which is to say copper country. And that deposit was discovered about 25 years ago. It's been in the permitting process for 20 years, with at least 5 years to go. And it's a fight that's worth having. It's 1 billion tons, in excess of 1 billion tons of ore at 1.5% copper. So it's 3 times the average mine grade worldwide. But the political reality of building a big mine today in frontier markets or in the West is that it's a capital intensive, time intensive, labor intensive, very, very, very difficult exercise. All of that weighs on supply.
You also have the Pebble project, I think, in Alaska that has an enormous amount of copper and gold. And environmentalist lawyers, the EPA here in the United States, Environmental Protection Agency, environmentalist lawyers, they're fighting that project tooth and nail. I mean, they're spending many millions of dollars in legal bills fighting that project. I don't think that project, I mean, it's been delayed a very, very long time. It may never get developed. And that has an enormous amount of copper and gold there too.
Point very well taken. My suspicion is if the various developers around that would have spent more time on community relations, they would be way, way, way further ahead. The industry lost that fight on the ground, not in Washington, although they lost it in Washington too.
So there's lots of risk with the mining company. And what the average listener doesn't understand is, unlike a royalty and streaming company, which can have a diversified portfolio of cash flows, if you're a mining company, you might only have 5 or 6 quality assets. And if all of a sudden, like one of these governments decides to change the rules for taxes or becomes anti-mining, like in Peru. I mean, look at all the rules changes for Peru. Peru over the last 12, 15 years, the rules have just become increasingly more mining. But now in Latin America, Rick, especially the last 12 months, you have even more protests on the streets. A lot of these governments, I think Colombia for the first time in decades is electing a socialist in the last couple of weeks. So you have more anti-mining policies coming out of South America, Latin America, and more pro-socialism, which are, I guess, going to start taxing the resource industry, because these mining companies, one of the negatives about the mining industry, they can't move their businesses. So if governments start going after them, it's very difficult for the mining company to transition to another country.
Absolutely correct. And trying to find a pro-mining country these days is a chore. It isn't merely Colombia and Peru that have moved in a more socialist direction. So have countries like Canada, the United States.
Yeah, I totally agree. Unfortunately, it's the new normal for having to deal with resource industry. But why do you think that the traditional value investors like David Einhorn, Warren Buffett, who would normally avoid mining stocks or oil and natural gas companies, we're seeing their disclosures, their 13Fs? Warren Buffett's buying a ton of Occidental Petroleum shares. David Einhorn, for the first time in, I think, ever, because I normally track a lot of his companies, he's buying oil pipeline companies. He's buying oil and natural gas producers. I think he even bought base metal miners. I think him and Stanley Druckenmiller even started buying shares of base metal miner and coal miner Teck Resources.
That's correct in both cases. The coal business in particular got grossly oversold. Everybody in the world was against coal except people who wanted the lights to go on. The consequence of that is that while coal faltered in investment markets, the largest year that the world has ever seen for coal demand was 2021. And it will be eclipsed in 2022. Meanwhile, coal companies were selling at twice EBIT when they had 25 years of resource base. That was too cheap. The same thing happened in the oil and gas business. You had a circumstance where the industry got waxed in sort of the public relations sphere because of carbon, and then it got waxed in the market by COVID. Remember that the price of oil in the United States went sub-zero for a little while. It was pretty obvious, I think, to Mr. Buffett that either the oil price returned to the total cost of production, including working capital, or nobody's cars would start. And it was very likely that door A would prevail over door B. When the price of oil got to the point, pardon me, where Occidental was generating ginormous free cash, what Buffett noticed was that the oil industry as a whole worldwide still wasn't spending enough money on sustaining capital to maintain production, which is to say that the price levels that allowed Occidental to generate the amount of cash relative to its enterprise value that attracted Buffett were likely to stay in place for years and years and years. I think that's what Buffett saw. You'll note, too, that in addition, although in lower quantity to buying Occidental, he has been buying the integrated petroleum company Chevron, and he has been for about 2.5 years buying the oil refining companies, noting that no new refineries have been built in the United States for more than 30 years, while demand for refined products in the United States in that period of time, including export demand, has almost tripled. The consequence of that is that there's a critical shortage of refining capacity in the United States with no prospect of being able to permit a new refinery. And refining margins are at record levels, as has been noted by such diverse financial commentators as Warren Buffett and President Biden.
So do you think then that dividends for oil and natural gas companies, oil pipeline companies, oil refiners, base metal miners, do you think that these companies could potentially have more dividend growth in the near future, long term, based on the policies, the supply side shortages we discussed earlier in the interview, than maybe these normal consumer monopoly, consumer staple companies that tend to do well in a recession or depression historically, like a utility company, basically like a traditional value investor, Warren Buffett stock, where Warren Buffett would retreat into like a, a Procter & Gamble, Johnson & Johnson type of company. Do you think that the resource companies, that's why these traditional value investors are heading there? They see the free cash flow, they see the dividend growth compared to the problems that maybe these consumer staple companies have not had in the past.
I don't want to comment on them versus the consumer staples companies because I'm not that kind of analyst. I don't follow those companies. I can say that there are a number of extractive industry companies, particularly companies in the iron ore business, the coal business, and the oil and gas business, that are generating substantially more free cash flow than they can reinvest in their businesses. And the right thing to do in that circumstance is give the free cash flow back to shareholders. Certainly what Buffett saw, having been a preferred shareholder and a lender to Occidental Petroleum and knowing it reasonably well, is that at oil prices above $70, Occidental coins money. And I think Buffett looked at the likelihood that the oil price would go below 70 relative to the probability that it would stay well above 70, and decided that it was more likely than not for the next 5 years that Occidental would generate returns that were in excess of their ability to redeploy, even after they had redeployed enough free cash flow to maintain production at current levels. In addition, what he saw was a tremendous inventory of undrilled locations in Occidental Petroleum in the United States. He saw a business that was generating in excess of 50% unit operating margins that could grow its production for the foreseeable future at 7 or 8 or 9% compounded. That's an unusual set of circumstances. Buffett was quoted years ago as saying his dream investment was something that generated a 15% return on capital employed that could use some leverage to increase that and could reinvest the proceeds, generating the same sort of rates of return. And I think what he saw in Occidental in the near term is something maybe nicer than that. A company that could at once increase dividends, shrink market capitalization, and still generate sufficient free cash flow to exploit the numerous opportunities they had, not merely to maintain production, but rather to grow it too. An unusual set of circumstances. That same set of circumstances, I think, confronts investors certainly in Vale, in Rio Tinto, in BHP, as a consequence of the fact that they've made enormous new project and sustaining capital investments in the iron business. And if the economic climate with regards to steel consumption doesn't turn down markedly, those businesses will generate more free cash than they can deploy, while at the same time they have sufficient new project investments that they can, at least for the 5 to 7 year time frame, maintain current levels of production. It's an enviable circumstance. When you get to much further down the quality chain, however, companies that are that virtuous become very scarce.
Are those base metal miners, did they hedge at higher base metal prices that were 6, 7, 8 months ago, or are they susceptible if there is a recession or depression, China slows down enormously, China stops building with their construction, and base metal prices totally crash and stay low for, say, 6, 12, 18 months? Are the base metal miners then, they're not hedged with higher base metal prices to ride that storm out?
It's very difficult to hedge that much iron ore or that much coal. So I would regard them as functionally unhedged.
Okay, thank you for that. We're recording this interview on Friday, July 15th for our listeners out there. Also, Rick, we're at a natural gas price. It's rallied. We're above 7 for a U.S. natural gas price. That is a very robust natural gas price. So you brought up Occidental Petroleum. Warren Buffett's buying a lot more shares. I think he just added another $10 billion in disclosures just in the last month or so. So he's still accumulating. I think he's almost to 40% of the company of Occidental Petroleum. He's just buying an enormous share position of it. But at these natural gas prices, a lot of U.S. natural gas producers can mint money. Plus, if they're exporting liquefied natural gas, although the terminal right now, one of the main ones, the Freeport one, is down, I think, until at least September. I mean, there's a big spread between exporting natural gas from the United States and then selling it to Asia or to European Union. I mean, there's a big profit potential there, too.
I agree with that completely. Several investment banks that focus on energy have been pointing out that the enterprise values of U.S.-based natural gas producers using a 10% discount, which is the oil industry standard, are discounting themselves $4 natural gas, which is to say that the market is suggesting that these companies would be fairly valued at $4 natural gas. And as you suggest, at 7, a number substantially higher than 4, they will continue to generate earnings surprises relative to their enterprise values that are very, very positive. And the only thing, frankly, that keeps us from selling an awful lot more natural gas is, as you point out, the facilities for liquefying natural gas and selling it to, sending it to Europe to replace Russian gas, or selling it to the Pacific Basin, particularly Japan, where it's still being used as a substitute for nuclear power. We could produce and sell an awful lot more gas if we had the correct infrastructure to do it.
I think China is also going to have to switch a lot of their coal-fired power plants. And for listeners out there, they built one new coal-fired power plant per week for decades. So eventually they're going to have to switch over more of those coal-fired power plants to natural gas because it's cleaner burning. There's a lot of benefits to using natural gas instead of coal.
By the way, the Chinese are still continuing to build coal plants. What the Chinese have said very quietly is solar, yes. Wind, yes. Nuclear, yes. Hydro, yes. Gas, yes. Coal, yes. China still has 150 million people that they need to urbanize. Chinese demand for energy is insatiable, all forms of energy. And while the Chinese are happy to play around with the Kyoto protocols, they're still more interested in increasing the material well-being of their population, which means that the Chinese are still building coal plants like mad.
So with these natural gas prices, we've already seen just in the last couple of weeks, there's been over $9 billion in mergers and acquisitions. Do you expect a mergers and acquisitions boom in oil and natural gas and maybe some other mining company spaces, other commodities? I mean, we've seen recently, we saw a shotgun wedding in the last couple of weeks with Alexco. They're the major silver producer in Canada. Their costs were too high. They had supply chain problems. They basically had to agree to sell the company to Hecla. Do you think we're going to see more of those types of scenarios in the mining industry, depending upon how long metals prices stay low?
In the mining business, yes. In the oil and gas business, no. In the oil and gas business, if you see mergers, they'll probably be virtuous mergers. Mergers are almost always in the long term good for the industry and good for shareholders. You put more assets under management relative to general and administrative expense when you have larger companies, which is a very good thing. The reason that more mergers don't occur is that normally the management teams of both companies want to be the successor, and that's not what happens. In Alexco, you had a situation where the circumstance became untenable. I certainly hope that you see many more mergers in the mining space. One of the things that burdens the mining industry is that we simply have too many management teams. There's too much general and administrative expense in the mining industry relative to assets under management or relative to revenues. And we need to solve that one way or another.
We're also starting to see a lot of aggressive deal making in the gold royalty space. Now, these companies, they don't have to worry about high energy prices, high electricity prices. They have a portfolio, the larger ones do anyway, medium-sized and larger ones, of diversified cash flows. So Sandstorm Gold went and bought Nomad Royalty. I mean, that combined company, Rick, I know you liked Sandstorm before that merger and acquisition. You were talking about it on your BNN Bloomberg interviews about the cash flow and the growth and the valuation. I mean, that combined company 2, 3, 4, 5 years from now, it looks amazing with the cash flow growth, the dividend growth, and their diversified portfolio and their growth pipeline.
I would agree with that. You'll note too that they also bought the royalty portfolio. I guess it was Ontario Municipal Employees, OMERS,
and Glencore,
and Glencore.
It was a joint venture, yeah.
Yeah. So they really bulked up. And you will see the benefits of that accruing at the same time that you see the restructuring of their financial arrangements in Turkey, which will take them from a minority working interest holder to a royalty and stream holder in that asset. I think you're going to see a circumstance with Sandstorm in particular over 2 or 3 years where the amount of cash that they begin to generate really surprises people. I hope you continue to see mergers and acquisition in the royalty and streaming space because that business has the ability to have extraordinarily low general administrative expense. The last time I looked, selling general and administrative expense, which is to say fee expense at Franco-Nevada, was about 12 basis points.
That's like an index fund.
Yeah, I mean,
it's lower than an index fund, I think. Now
it's just an unbelievable number, and that's extremely beneficial for shareholders.
And don't they have like over 200 assets? I think throwing off cash flow, so they have a really big portfolio of diversified cash flow. Although I think they need to be aggressive and go and do a deal in the not too distant future and go and buy something else.
There are 3 or 4 very large potential royalty and streaming transactions out there. And I'm certain that Franco-Nevada and Wheaton Precious are looking at both of them. If I know about them, for sure they do. There's probably $10 billion in deals to do, financing deals to do in the next 12 months.
I think Franco was actually looking at buying Great Bear Royalty, and I think Royal Gold, they came out of nowhere and beat them to the punch. So I think Franco was looking at Nomad. I think Franco was looking at Great Bear Royalty, and there's a couple other options for them too as well.
But there are also some much, much, much bigger fish for them.
Oh, yeah. Like a Cisco Gold Royalty or Triple Flag. Yeah, those are the mid-tier ones if Franco wants to be really aggressive. Yeah. So I want to transition now to which commodities you think have some of the best supply and demand fundamentals, in your opinion, over the next 2, 3, 4, 5 years.
2, 3, 4, 5 years for most people, they need to increase their allocation to gold space. In the very near term, I think the gold price is going to be weak because I think the US dollar continues strong. But looking just a little further out, the wind is really truly in gold sales. Gold does well when people are concerned about the purchasing power of savings and investment instruments and fiat currencies. And in that context, what we see now is tailor-made for gold. You hear about the fact that we're tapering quantitative easing. What's happening is that the Fed isn't buying treasuries, they're buying mortgage-backed securities, but they're expanding their balance sheet like crazy. And guess who issues those mortgage-backed securities? Fannie Mae. In other words, they're buying their own paper still, supporting the housing market. So we have quantitative easing. Remember, they're buying these bonds with currency units that they conjure up out of thin air. The second concern, of course, is debt and deficits. We're still going to run a $2 trillion deficit this year in the United States, on top of on-balance sheet and off-balance sheet liabilities at the federal level of almost $150 trillion, which speaks to credit quality. But the most pernicious thing is, of course, negative real interest rates. The saver who buys a U.S. 10-year treasury gets paid about 3.6 now in a currency that the Congressional Budget Office suggests is declining in purchasing power by 9% compounded, which is to say the government guarantees that if you loan them money for 10 years, you will lose 5.5% of your purchasing power each and every year for 10 years. This is a circumstance that's tailor-made for gold. Tailor-made for gold. It isn't responding right now because the dollar is strong and because nobody has really had to own gold for 40 years. The tides are changing. So people need to be in gold, and people who are willing to do the work need to be in gold stocks. Despite the fact that the outlook for gold is attractive, the gold stocks are selling at some of the lowest reasonable multiples that I've ever seen in my career.
Do you think
I'm sorry?
Since you're bringing up gold, do you think then that the senior gold producers or the low-cost mid-tier gold producers, or the low-cost mid-tier gold producers, basically any of the sizable low-cost gold miners, do you think that they're going to be more aggressive than usual at doing mergers and acquisitions in the next 6, 12, 18 months, especially if prices go lower? They're going to see that as a buying opportunity compared to the past.
I don't think that the institutional investors are going to let them be as generous as they were in the past. If you look back to the decade 2000 to 2010, what you will see is that the gold mining industry wasted about $70 billion in stupid acquisitions and stupid new builds. And right now, the management teams of the mining companies aren't trusted enough by the market to be aggressive. I think they should be being aggressive. But they aren't being aggressive. The other circumstance that you have is at the very top of the feeding chain, places like Barrick or Newmont, the question becomes which acquisition is relevant. And I think in that circumstance, the great big gold producers are going to have to morph into hybrid copper gold producers in order to find assets that actually move the dial. My hope is that you will see the formation of more equinoxes, more northern stars, more companies that can acquire assets, in particular acquire assets that were cash starved, capitalize those assets, turn them around and grow. These bigger companies, the companies that grow in this manner, attract larger market capitalizations, attract more liquidity, inevitably higher share prices than they otherwise would have, which lowers their cost of capital.
Are there any excuse me, are there any commodities right now where many of the producers are barely breaking even or producing at a loss?
Well, certainly uranium. We don't see it so much at the Cameco level, but if you look at the state-sponsored uranium companies, the Chinese companies, the big French government-supported nuclear companies, those guys are losing their behinds. The International Energy Agency suggests that the fully loaded cost to produce a pound of uranium worldwide, if you add back prior year write-downs and you add in cost of capital, is somewhere around $60 a pound. So the industry's making the stuff for 60 and they're selling it for 45.
So you've said publicly that you really like Kazatomprom. They're considered the low cost producer because they don't do regular mining. I think they do in situ, which is the lower cost. Do you think that their costs and their financial statements are accurate because they're not listed on the New York Stock Exchange, so they don't have to adhere to GAAP? So do you think their accounting is accurate, their cash flow, their costs?
I believe their accounting is accurate. Their accounting, I wouldn't describe it as opaque. I would say that if you aren't used to companies that trade on London, if you aren't used to the accounting treatment that prevails in Great Britain, you'll have a more difficult time reading Kazatomprom's statement. Buffett once said that if you begin to get lost in the interplay between the balance sheet and the income statement, what you do is you look simply on the balance sheet for cash at beginning of period, and cash at end of period, and see if a company is building up cash on the balance sheet or stripping cash off the balance sheet. And by that measure, Kazatomprom is a very healthy company indeed.
Do you think that they can flood the market, though, if they start increasing production, though?
Could they flood the market? Absolutely. What they have said many times publicly is that they won't restart Inkai or any of those other companies or any of those other projects if they can't obtain the price that would be necessary for their major competitors to generate cash. What they have said is just because you can produce for $15 a pound doesn't mean you should take 20 for it. If with a little discipline you could take 55. So what they have suggested is that they and Cameco should be and will be the market leaders in terms of pricing.
Okay, so they don't want to take, even though they're a state-owned enterprise, they don't want to take kind of the Saudi Arabia approach, whereas in the past, OPEC tried to bankrupt a lot of private sector oil companies by overproducing the amount of oil and bankrupting competitors and gaining market share. They seem, or at least they're saying publicly, that they don't want to do that right now.
The middle managers at Kazatomprom, the younger people, suggest that taking too low a price for uranium now, even on a net present value basis, is robbing future generations of wealth. Why sell for 20 what you could sell for 55 or 65?
Yeah, I agree. It's smarter to focus on being efficient and profit margins rather than trying to bankrupt all of your competitors and take total market share.
Right.
So I want to ask you about silver miners because we're at a silver price. We're below 19, Rick. We don't have the Q2 earnings numbers out yet from the silver miners. They should be out probably in the next 3 or 4 weeks. I think it's going to be very ugly with energy costs, and silver has been one of the worst performing commodities over the last 12 months. Do you think at some point a lot of these, the mid-level costs for a lot of these silver miners, now a lot of them have transitioned to buying gold mines over the last 6, 7, 8 years. I think Pan American Silver was one of the first ones. But do you think we're going to see a scenario if silver keeps going lower with the energy costs and electricity costs where they are, that these silver miners could be producing at losses like in 2015?
Yes. Yeah, I absolutely do. The silver miners operated at a disadvantage, the primary silver miners, because about 80% of world silver production occurs as a byproduct of producing other metals. And in those cases, the cost of production for silver is the marginal cost of extracting it from a copper stream or a gold stream or a lead and zinc stream. So the pure silver producers have always operated at the mercy of the market. And certainly the silver prices that we're seeing today, in conjunction with the rapidly increasing input prices that you've talked about, the wages for skilled labor, the prices for cement and steel and consumables, and in particular, the energy prices, I think for the next while, we'll have the silver producers between a rock and a hard spot. It's also worth noting that many of the prominent silver producers in the world operate in political jurisdictions that, with regards to mining, are becoming more challenging. I'm talking about, as an example, Peru and Mexico, but also Russia. The politically engineered very high ruble price paradoxically has really hurt their silver industry. Their inputs are priced in rubles, which has been manipulated higher as a controlled currency, while they have to sell the dollars where they can in U.S. dollars, which has been a bit of a challenge. So the silver industry has faced a real challenge. That being said, my experience has been when a gold bull market gains traction, after a couple years, the silver market wakes up and moves much further, much faster. I'm not always sure why that is. I guess it's the lower unit cost that silver has for speculators. But my experience in prior bull markets has been, as Doug Casey put it, the market capitalization of the silver companies, when they attract the attention of the generalist investor, is not big enough to hold the capital. And you get these really explosive moves in share price. The consequence of that is that I will likely this year, 2022, increase my silver equities portfolio precisely because they're going through bad times and everybody hates them.
Yeah, so from a sentiment perspective, valuations, there's good opportunities there, especially because you're a contrarian investor. You've been through so many bull and bear market cycles. The best investments, and you look at companies, Franco-Nevada in 2008, 2009, Sandstorm Gold was created in 2009, 10, and their best investments were in 2015, 2016 that are bearing a lot of fruit now. The best investments are made in bear markets when there's blood on the streets, and then 3, 4, 5, 6 years later, that's when they bear enormous fruit.
Exactly correct. Exactly correct. It's always been that way. It always will be that way. And most investors, never seem to get on the page.
We'll see which silver miners survive, though. I mean, I think there's going to be a lot more shotgun weddings similar to Alexco, depending upon what happens to silver prices. I mean, if we go another $1, $2, $3 an ounce lower, there's going to be forced mergers and acquisitions at really bad terms. A lot of retail shareholders are going to get pissed. But I think the smart silver miners, like a Pan American Silver, they started diversifying and buying low-cost gold mines 6, 7, 8 years ago. So they have 50% of their revenues in gold, which has better margins on gold mines and silver mines. So they're more able to weather out the storm, because there's very few silver mines, Rick, like Mag Silver, where they have 400 grams per ton average head grades, and I think like $10, $12 an ounce costs.
It's interesting that you talk about Pan American's investments in the gold business. Of course, that occurred with the takeover of Tahoe, which they did to get control of the Cascabel silver mine, which they've never been able to return to production. That gold diversification was in effect a very happy accident. They looked at it as bringing down the cost of acquiring Cascabel, or they looked at it as Tahoe's market capitalization only reflected the free cash flows from gold and didn't reflect Cascabel. It's interesting. It's an interesting note on things. As you point out, the consequence of their gold production has been that the company has stayed very healthy through very weak silver prices and through challenging political times, both in Peru and Mexico. It's worth noting on on Pan American Silver, by the way, that they have two assets on the books, one Navidad in Argentina, the other Cascabel in Guatemala, both of which are half billion ounce high-grade silver deposits, neither of which are producing. If either of those overcame their political challenge, either one of them could double Pan American's production. And from my point of view, you get basically 1 billion ounces of optionality in Pan American for free.
Plus, you have a low-cost producer compared to some of these other riskier silver miners.
Yep.
And then Mag Silver is probably the lowest cost producer, but they have a special project and they're not operating. They're a special junior because they're like a joint venture partner. They don't operate the mine. Fresnillo operates the mine.
And that would probably, in the wrong set of circumstances, generate a substandard takeover if there were to be one. That was an interesting discussion I had. I was talking about Mag Silver with a different silver company that has a history of being acquisitive, and mentioned that Mag was hostage. And it was interesting. My counterparty said to me, no, not really. That deposit is of such high quality that there are several of us who would buy the minority interest. And in addition, it would be probably of interest to Wheaton Precious, who would buy the minority interest and then create a stream on it and sell it on to Fresnillo. In other words, eliminate the joint venture partner aspect and rather take a stream on that production. I'm increasingly attracted to Mag as the price goes down. I'm attracted to Silvercrest, which had its first pour, not in commercial production yet, had its first pour and continues to see its own price go down. I love the fact that I can watch these companies progress. I can look at the interplay between the balance sheet and the income statement. I can study the stock. And as I get more convinced it's a good buy, the price goes lower. That's a wonderful set of circumstances.
Well, Fresnillo actually tried to play games delaying bringing the mine online, and they actually tried to screw over Mag Silver and then get them to agree to a lower price, like essentially hostile takeover bid. So there was lawsuits back and forth before the mine came online. But now that Mag has cash flow from it, it's going to be a lot harder for Fresnillo to play games like that.
Yeah, the take under, as we called it, was so spectacularly unsuccessful that since then. Fresnillo has begun to play nicey.
So I have one more question before I let you go. We've seen feasibility studies come out recently. If it's like 12 months, 18 months ago from the last feasibility study, the cost differential, the cost projections for materials costs, shortages in supply chains. Do you think the cost to build a new mine is up enormously compared to the last 2-3 years?
Zero doubt. There's shortages everywhere. If you understand as an example that energy is a primary input, not just in operation, but also in construction, energy prices have doubled. Skilled labor is extremely difficult to get. Materials aren't just more expensive, but there's a shortage of them. And I mean, all kinds of materials. From truck haul tires, through crushers. I think I'm making this number up, Jason, but I think you're seeing minimally 20% compound total cost escalations annually.
I think a lot of these projections, and I've looked at some of them, it seems that the feasibility studies are up. If they have to redo them, the costs to build a new mine are up over 50% in a lot of different countries in under 3 years.
That wouldn't surprise me at all. And of course, remember too that mining is a capital intensive business, and the increasing interest rates have become more extreme in project finance for non-investment grade companies.
Oh, yeah, it's priced off the 10-year treasury yield, right? So if
it prices up the 10-year treasury yield, imagine what it does to a non-investment grade limited recourse project finance facility.
Plus, you have all these institutional investors, and they're dumping their commodities exposure. So this is not all; these are all, I would say, headwinds for building new mines.
Headwinds for building new mines, tailwinds for patient investors who want to be in the space.
Is this a big time advantage then for the low cost producers? And because if they do have good margins and free cash flow, they can go and buy up quality assets now for pennies on the dollar. And then, as we've seen in past bear market cycles, a couple of years later, the low cost producers then have even more growth, even more cash flows, even more diversification a number of years later.
I don't think we're there yet, but I think the answer to that is yes, absolutely.
Well, Rick, I really enjoyed our discussion today. If my listeners want to follow your work, actually, I want to plug this since you have really good guest speakers, and I know you focus on mining stock education. Your guest speakers at your conference coming up at the end of the month here in July in Florida, you have Grant Williams and Nomi Prince as guest speakers. And then tell my listeners about your conference at the end of the month in July in Florida.
Well, I'll start with this. It's my 30th Natural Resources Investment Symposium. So obviously that educational product has stood the test of time. This is the 30th year I've done it. As you suggest, we have great headline speakers: Grant Williams, Nomi Prince, Daniela DiMartino Booth, David Stockman, Jim Rickards, Doug Casey. In addition to having these wonderful big picture gurus, we traditionally have had some of the best analysts that money could buy. If you like the strategy that was espoused, here are the techniques to make it work. More importantly, Jason, for 30 years, we've had a function that's been called the Living Legends. We invite 6 or 7 people who have built multi-billion-dollar natural resource companies from scratch, telling about how they did it, telling about how they got through tough times, but telling you really how to become a better investor as a consequence of their story and how they invest. Finally, while at most investment conferences, the exhibitors are regarded as advertisers, as revenue, my attendees for 30 years have told me that my exhibitors are content, not advertisers. The consequence of that is that every exhibitor at our conference is vetted. It has to be owned in an account that I manage or advise or in my own account. That doesn't mean, sadly, Jason, that every stock I ever bought goes up. Far from it. What it does mean is that, well, at most conferences, the qualification to be an exhibitor is a check that cashes. At our conference, the exhibitors have to be well enough vetted that we own them with our own money. The consequence of having those rigorously high standards for 30 years is that I'm able to say to any attendee to any of my conferences, if you don't believe you got your money's worth, I'll give you your money back. No questions asked, money back guarantee. We would ask that if you ask for your money back, you tell us what we did wrong so that we can make it better next time. But that's not a requirement. Absolute ironclad money back guarantee. If you come to the conference, you don't think you got your money's worth, we'll give it back to you.
That is rare nowadays.
July 26th to July 29, Boca Raton, Florida. Some of you will remember this conference for 27 years in Vancouver, British Columbia. The public health challenges associated with COVID on both sides of the border meant that I didn't have the courage to put it on in Vancouver. So this year it's in Boca Raton.
Did you move to Florida also to take advantage of the low taxes leaving California now?
I live in Washington State, partially because I wanted to move back to the Northwest, but also certainly the difference in arithmetic, which is to say the income tax rate in California is 13.8. The income tax rate in Washington is 0. Capital gains tax rate in California is also 13.8. The capital gains tax rate in Washington is 0. The arithmetic around Washington State or Florida relative to California is pretty attractive.
Yeah, I grew up in Southern California, but a lot of Californians the last couple of years have fled the state en masse.
Yeah, those of us who were born in California, I'm one of those, would say that the voters broke up with us poorly.
California is turning into Greece or Italy. The policies are that bad.
I would agree.
Well, Rick, I want to thank you so much for your time. If my listeners want to check out Rule Investment Media, maybe follow you on Twitter, follow you on social media, have you set up the YouTube channel yet? Are you releasing content, doing interviews?
I'm releasing content, and I'll provide them all an incentive to do it. Any of your listeners who like what I have to say about natural resources should go to my website, ruleinvestmentmedia.com. There, you can list your natural resource stocks. Please no pot stocks. Please no tech stocks. Please no cryptocurrencies. Just natural resource stocks. I'll rank them 1 to 10, 1 being best, 10 being worst. I'll comment on individual issues where I think my comments have value. Further, if you're an accredited investor and like private placements, I think the upcoming capital shortage in the mineral exploration business will probably present very nice private placement opportunities. Because I'm no longer a stockbroker, because I'm no longer compensated, I can now tell accredited investors what I'm doing with my own money in the private placement space. If you'd like to know that, in the comments section on the rankings database page, just mention placements. Further, Jason, as I told you before we went on the air, I'm celebrating retirement by backing the old team at Everbank and building a new bank, a good old-fashioned bank, one that has money in it, one that lends to people against good collateral, and one that, as a consequence of low non-interest expense, is able to pay deposit interest rates in the highest decile nationwide. Many of your listeners will remember this management team's prior success, which was Everbank, a bank they took from zero to $28 billion in net asset value before it was sold to TIAA-CREF 6 or 7 years ago. Basically, we're trying to build back Everbank better. If you care about that, on that same page, just mention bank, and we'll keep you in the list to hear more about a good old-fashioned bank, one with money in it.
And I'll also put a link to your conference in the information and description section below the video for listeners who want to check that out.
Thank you so much, Jason.
Excellent. Well, I really enjoy our discussion about natural resources. I think it's a contrarian's delight. So in the short term, like you said, gold prices, silver prices, other commodity prices may go down, but this presents opportunities. And 2, 3, 4, 5 years from now, as we've seen in past bear market cycles, they eventually become bull markets because low prices cure low prices. We still see shortages. I think there's a big food and energy crisis. And there's, as you mentioned earlier in the interview, there's big problems with copper on the supply side. So eventually we're going to have to see higher commodity prices in the next couple of years unless demand totally collapses.
I would agree with everything you said. The caveat, of course, is, as you mentioned, is a recession.
Until the central banks decide they want to start handing out stimmy checks, or there's infrastructure spending, and then they start building more things, and then the materials that are needed are all going to be commodities.
Which, as you suggest, is very likely.
Yep. I think a lot of these infrastructure spending things are likely make work projects or green energy or whatever the politicians in power decide.